Many things have changed since the local final. The markets are not the same. COVID-19 rules the headlines. As of last Sunday, more than 2 million were infected, and unfortunately, more than 160,000 deceased. The focal points, US, Europe, and China. And although the virus has been developing around the world, the Mexican authorities have just taken measures to try and contain the outbreak, but there is no clear view about the timing and efficiency of said measures. Now that we're on the same page, let me introduce you to Grupo Aeroportuario del Pacífico, or GAP for short. We are proudly representing Mexico, and today we're going to tell you why you should hold the stock of this company. GAP is a Mexican business that manages and develops 13 international airports within the Pacific, Central, and Caribbean regions. As of last quarter of 2019, they started operations in the Norman Manley International Airport in Kingston, Jamaica. Plus, we analyzed how GAP makes money from two main sources: aeronautical revenue, which is regulated, such as tariffs, and non-aeronautical, which is not regulated, such as commercial space leasing. Mexican airport operators work under concession agreements which are divided in 5-year cycles. Within each cycle, the company and the government negotiate on maximum tariffs, mandatory capex, and other regulatory issues regarding aeronautical revenue. All of this is summed up in the Master Development Plan. Returning to GAP, we grouped the airports into 3 main clusters: growing cities, touristic destinations, and business and hubs, the latter being a relatively more inelastic sector in income terms, which represents an important diversification characteristic when comparing against its Mexican peers. It is also relevant to mention that 82% of total revenue in 2019 proceeded from the 2 airports in the business hubs and 3 touristic destinations.
An important singularity of the Mexican airport industry is that it has 5 regional monopolies, competing for holding the major traffic hub. In total passengers, GAP is the second in line. They have been in a higher than average passenger growth, growing double-digit rates of 14%, while the market average is 9%. But how does it compare to other airports abroad? Comparing with the US, GAP has 45 million passengers, which is less than O'Hare or JFK airports alone.
We are going to focus on 3 main subjects: macroeconomic crisis, solid fundamentals, and market uncertainty. All these 3 round up in a year-end target price of 157 Mexican pesos, which would represent, as April 17th, an upside of 14%. That may seem attractive, but the 3 things we're going to discuss, especially market uncertainty, present an atypical situation that keeps us neutral. Throughout the presentation, we're going to answer our main question: can GAP fly away from crisis? In order to do so, let us start with macroeconomic crisis. As we said before, COVID-19 has changed the conditions in the market. We can see a sharp collapse since the health crisis started, both in the Mexican market and in the world. The outbreak not only affected the economy, one of the main airport operators' value driver has taken a negative hit. The number of flights in March has followed a severe collapse and had a major decrease when compared to previous years, which means less passengers followed by less revenue for GAP. But how does this affect GAP in the long term? Significant adjustments to Mexican economic growth have to be made recently. From the figure, we can appreciate a deteriorating economy falling to recession. Moreover, passenger traffic, one of GAP's primary revenue drivers, is closely related to Mexican real GDP. This relation quantified linearly by R-squared of 0.82. In conclusion, the health and macroeconomic crisis are going to affect GAP's future passengers, meaning less revenues for the future.
In spite of the macroeconomic outlook, GAP's financials are prepared for some stress scenarios. So next in the radar, we're going to analyze their solid fundamentals. Airport operators have followed a sharp decrease in pricing due to COVID, particularly the same trajectory as airline stocks. GAP has not been the exception, but airlines have more risk, and this is shown in a much lower ultimate C score. Airlines are in the distress zone and GAP is not. So if GAP is less risky, why are they having the same negative returns? Before coronavirus, regulatory risk was the company's main concern, but maximum tariffs exceed expectations, increasing 15%. Non-aero services had a steady growth of 20% in the past 2 cycles, and GAP's commitments were just as expected, with more than $900 million, 5 times greater than the past cycle. But this is obligatory despite the crisis. Guadalajara and the cross-border express at Tijuana are two of the most valuable assets. We can see that business and hubs contributes the most to the total growth, except on 2015 when they started operations in Montego Bay. Then we have that before the CBX, GAP maintained a steady trend, but after the trend changed dramatically. GAP announced a contingency plan where cost control measures, delay of non-obligatory capex, and dividend postponements are the pillars. By now, they have more than $400 million in cash, a 5% decrease in passenger traffic in the first weeks of March, and having no debt maturities this year should help liquidity.
With all this in mind, what could we expect from GAP's performance in the upcoming month? Let's move to the third topic under GAP's radar, market uncertainty. As we've been mentioning, airport valuations have fallen dramatically. Interestingly, risk seems to be priced equally among all the operators, regardless that GAP has the highest international passenger traffic exposure and OMA the lowest. If we take a closer look at GAP stock price movements, we discovered they have been contained under a plus minus 5% range. However, in December and then in March, both the reveal of the new master development plan and the COVID-19 outbreak triggered a volatile episode in GAP's returns. Additionally, we analyzed GAP's comparables and we discovered that they are now trading below median value. If we then analyze EV/EBITDA multiple, we can see a fairly steady behavior. However, historical overpricing of the multiple appeared as a result of the favorable outcome of the new master development plan and a steep discount after the COVID-19 outbreak. The moral here is that we are under completely atypical circumstances. So in order to foreshadow what to expect under the current crisis, we look back at GAP's performance under previous stressful shocks. First, the H1N1 health crisis, which was similar to coronavirus but containing Mexico. And second, the caveats of the world economic recession. Yet, this is not the complete history. In 2008, the market as a whole took a hit. After the health crisis, GAP was able to outpace the airlines, but it was not able to outperform the market. So we can use the health crisis and the world economic recession as proxies. However, current forecasts have highly incomplete information, and hence they're highly uncertain.
So now, let's talk money. What is the market pricing? The maturity of the concession, the operative flexibility under regulation, the ability to boost returns, and demand growth. All of these are considered in our year-end price of 157. But how did we build this number? 20% comes from dividend discount, with a final price 153. Another 20% comes from multiples valuations with a price of 160. And the final 60% comes from DCF with a base scenario of 158. We perform a geometric Brownian motion in order to determine there is a 52% probability of upside. Focusing on DCF, we perform a sensitivity analysis to see how coronavirus shock and recovery period affect cash flows. With a conservative forecast, we get close to today's price. But once we have variability with a pessimistic forecast, we can go well below it. The company's relative valuation has been losing the small premium it had against its peers. And looking forward, the market penalizes GAP reaching discount levels under the comparable median. In order to move to a buy or a sell, we would need to see a clear tendency, upwards or downwards. Summing up the uncertainty in the markets, we perform a sensitivity analysis on all of our models, giving an interval of around 100 to 190.
1 minute remaining.
Comparing to Monte Carlo simulations, the interval is much bigger, which means that historical returns cannot predict these atypical returns. So let's wrap it up and answer our main question. Can GAP fly away from crisis? The coronavirus shock has deteriorated market conditions and taken GAP to a sharp downfall. But some solid fundamentals should keep it on a positive course. Yet the market uncertainty has increased, making volatility a major player at the moment. Considering this, we believe that the path ahead is still turbulent, and as randomness has the last word, we remain neutral, issuing a hold recommendation. Thank you. Any questions?
Given the uncertainty that you acknowledge, what kind of condition is the company's balance sheet in?
Yes, thank you for your question. Regarding that, the company has 10.5 billion pesos in cash, 65% of those in US dollars, which would help the liquidity of the company. Regarding this question, Viri has another insight.
Yes, with this balance sheet, we know that we have current assets, we have a lot of passives, but the most important here is that we have cash buffer days. This means that how many days a company will survive without any inflows and paying all their outflows. We mean outflows with all the operating costs, the debt interest, and also the capex that they have to pay. So we have 200 days that they can survive without anything, any cash flows.
Is the Mexican government doing anything to help the liquidity of these of the airports to keep the economy going?
Yes, that's a very important insight. As we are speaking, the government of Mexico has not determined yet a complete measure or a measure for the airlines to support in financial distress. But, and this is why this can be an important factor for the, that can be, an important factor for the volatility, as we don't know what the government measures are gonna be. That's why we're issuing a whole recommendation.
The new MDP requires an inordinately larger amount of capital expenditures than the prior one did. Does the company have the latitude under any thresholds to reduce CapEx during this time of crisis?
Well, that's a really valuable insight. Thank you very much. As Viri mentioned previously, the cash buffer days gave us a metrics to know how stressed is the company going to be, assuming the really drastic situation where they do not receive any inflows or revenue. And there's also another important point. Yes, the MDP makes the company to disburse in mandatory capex, especially between this year and the next one, high amounts. But there's a clause within the MDP that if in the end of the year, the Mexican economy contracts more than 5%, they are able to renegotiate and kick that mandatory capex further into the cycle.
What portion of their revenue is from tourism versus business travel? And how did you factor that into your projections?
Sure. We took a closer look at that particular issue you're mentioning. And in terms of touristic destinations, let me go for some material regarding that. In terms of the type of airports GAP is operating, it has a very diversified portfolio. For example, here we see that the majority of the revenue comes from the business and hub cluster, and that's around 52%, and almost the rest comes from 3 touristic destinations, particularly Los Cabos, Montego Bay, and Vallarta.
Back on the new MDP, what level of passenger traffic is required once you get the recovery to sustain profitability?
Yes, the precise number, I do not know it, but we consider different scenarios in which we varied for the loss in passengers. So it would require a 40% in the passenger from last year in order to diminish all of the income of the company to zero. That would be 48 million passengers last year minus 40%.
Does the company face some kind of currency exchange risk? Is their debt denominated in US dollars or in pesos?
Thank you for your question. That is a very good question, and we've been thinking about this a lot. The debt is 30% in US dollars and 70% in Mexican pesos. Regarding the revenue, the company has a natural hedge as 23% of the revenue is in US dollars and 77% is in Mexican pesos. but and regarding the cash position of the company, they have 65% of the cash in US dollars as well. This is not also good, as the US dollar net debt to EBITDA is at 3x as of September of 2019.
Thank you.
So tell us a little bit about the management team and the board. How much insider ownership do they have? Do any of them have crisis management experience?
Well, you have a really good point, the board and the management. First of all, we have to understand that the equity of the company is divided in two series. Series B, that represents 85% of the equity that floats on the market. And secondly, 15% of the Series BB, but I go further within that in a moment. About the corporate governance, it is important to mention that there is only one woman in the main board of directors, and the rest of the directors and the first-class officers are men. And maybe that's part of why in our rating of the corporate governance, we see that as a weak spot. There is not such a diversified board in terms of gender. Another weak spot that might be of the corporate governance is the Series BB I was talking about. It's about 50% of the equity, and it does not float on the market. It is fully owned by Aeropuertos Nacionales del Pacífico. And the difference here is that, yes, Series B, regular Series B, can have a regular vote, and even 10% of the ownership of Series B represents the capability to elect directly a first-class officer, but Series BB owns that right without having any obstructions. So that would be another disadvantage of how the equity is divided in these two series, besides the gender situation I'm mentioning right now.
Talk about the strategy and the risk of flying internationally to Jamaica versus some of the other more Mexican pure play airports like OMAB.
Yes, that strategy was taken by the company to diversify their portfolio. That is because the concession that the government makes to private ownership companies such as OMA and ASUR, that are the Mexican peers that we use to do our valuation, the concessions work for a very long period of time. For instance, GAP concessions are through 2098. That's why until that time, other private ownership companies also have their concessions. So that's why the company is looking forward to diversify their portfolio in another foreign countries. Well, I would like to make a note in here. The first period of the concession is through 2048, and then they have the ability or the option to make an extension for other 50 years, all the way through 2098.
Did they have exposure to one or two airlines specifically? I think there's one called Volaris. That's one of their big customers. And what is their financial situation?
Can you repeat the question, please? Because I didn't catch it.
Yeah, I was asking about the airlines themselves that are your customers, and what their financial situation is.
Yeah. First of all, the bigger one and the one that we have moved total passenger is Aeromexico. We have 30%. It has 30% of our total passengers. And we have other ones. For example, Aeromexico, it's a legacy airline. And in financial numbers, it's okay. But for example, Interjet, we have a problem with that because it's having troubles. They have 10% of our total passengers. So if they go to bankruptcy, we in the short term will be in problems. So that's why it also helps to our whole recommendation, because also in the long and the medium term, it will be other airlines will absorb all the passengers. In the short term, will affect GAP.
Can you provide support for your DCF? What inputs did you use?
Sure.
That's time. Thank you.